Welcome to the KMG Fiduciary Partners Podcast. Here, we'll cover important topics on financial planning and asset management to help keep you informed and inspired for long-term success on your financial journey. Let's join the KMG team now for today's topic.
Welcome to the 10-Minute Advisor, brought to you by KMG Fiduciary Partners. My name is Rob Thompson, and I'm a CPA and Wealth Advisor with KMG. I'm here with Cam Kaiser, who's a CFP and Wealth Advisor with KMG. So, Cam, do you want to just go ahead and explain what we're going to be talking about today?
Today we'll be talking about what many call the greatest investment vehicle of all time, the HSA, otherwise known as the health savings account. How it works, how it started, and why it's such a great investment tool to use. So, as always, we have our producer Mark here with a stopwatch, so we can try to keep this within 10 minutes. Can you go ahead and hit the start button on that thing?
Ready to go.
All right, where do you want to start this off at?
I'm going to actually task you with giving us a little history lesson on the HSA.
Okay, let's challenge accepted.
All right,
so as the HSA in general hasn't been around for that long. It's been around for just about 20 years. But concepts and proposals for similar vehicles have been around much longer. Actually, in 1984, the National Community Pharmacists Association, otherwise known as the NCPA, published a plan to create a tax advantageous health savings account, or like a health savings account. They referred to it as the medical IRA. And at the time, it was all just theoretical. But in the early 90s, the medical savings account was established. And that was very similar to the HSA, with the main difference being that it was limited to who could use it. At the time, I think it was employers who had 50 or fewer employees, and some self-employed individuals. And then in 2003, Congress passed the Medicare Prescription Drug Improvement and Modernization Act, which introduced the HSA, or the health savings account. Again, this was very similar to the MSA, but it was way less restricted. The main requirement being that you had to be part of a high deductible health plan. So that being said, in that exciting little history lesson, can you please give us the functions of an HSA?
Sure. Thanks, Cam. Learned something new today. Didn't know really any of that. I had an idea of roughly when HSA started, but that was it. Anyways, yeah, so the functions of the HSA, I think it's important to understand really the tax advantages that come along with it. So in essence, the HSA is the only true tax-free vehicle out there from an investment standpoint. It's tax-free really all three ways. And what I mean by that is the contributions go in pre-tax. You get a tax deduction in the year of contribution. So right away, we're starting off on the right foot. Everyone likes getting that tax deduction. The growth then, so those contributions, you can actually make those things grow by leaving them alone and investing them in index funds or individual stocks, whatever's available to you in the HSA plan. So the growth on it's tax-free. And then once you go and pull it out for qualified medical expenses, it's also tax-free. So it's tax-free going in, growing, and coming back out. We don't have, like I said, anything else out there in the U.S. that's as tax advantaged as the HSA is. And the reason I get excited talking about it is because it's not just the tax piece of it, but it's honestly probably the most underutilized investment vehicle out there. I like to think of it as, basically another 401k plan that's earmarked for our retirement medical expenses. A lot of people don't feel like it's, maybe that. They may think of it as an FSA or something like that, but we'll cover that later.
Sure.
So, Cam, do you want to just give us an idea of kind of who qualifies for the HSA and maybe, who can contribute?
Sure. So the HSA is interesting, especially when you're comparing it to other financial vehicles that we've used in previous podcasts or future podcasts we'll probably talk about, in the fact that you don't need earned income in the year you actually made the contribution. You just need assets to fund the HSA. That being said, the main requirement is that you belong to a high deductible health plan. For a self-only coverage, that is $1,400. And then for family coverage, that's twice that, so $2,800. There's also what's called a MOOP requirement, or the maximum out-of-pocket requirement, which basically says that you can only be on the hook for X amount of dollars. So for a self-only coverage, basically after your copay and deductible, all that stuff's paid. So for self-only coverage, it is $7,050, and then like the high deductible, it's twice that for family coverage. So it's $14,100. And I think it's also important to note here that you can make contributions to an HSA up until April 15th, basically the tax year. Instead, it's not based on the calendar year. So you can make them, like I said, you can make them in April. You don't have to stop making them after January 1st.
That's a really good point. 'Cause that's like one of the few things that you can do after the calendar year closes that can still kind of improve the result of your income tax return for that year. So yeah, you have up until April 15th unless you extend and all that.
It makes it a little easier to strategize, right?
Yeah.
No.
So I want to just talk about how powerful the HSA is, and I think the best way to do it is to, I'm not going to name names, but I had a client who was, you can call him, I guess, an early adopter of the HSA plan. He would have gotten in and opened one up probably right when they became available sometime in the 2003 or 2004 time period. And this guy was, I mean, I mess with him all the time because he wasn't a financial advisor, but like if he, wanted to pick up a second career after he was retired, he could do it. Very savvy, and he recognized the tax benefits of this HSA, and so he really put the pedal to the metal and decided he's going to max out his HSA contributions each and every year, make sure his funds are invested, and then leave them alone. He let all of that money grow tax-free for basically his entire career, the remainder of his career. So he retired, I think, sometime in 2019. And that's when we were going through financial planning with him, and we discovered that he had a pretty significant or substantial balance in his HSA. And so we got to talking about it, and he said, I have not paid for any medical expenses out of this HSA plan. I paid for it all out of cash flow, straight out of my checking account all these years. And he had pretty significant health issues for a number of years there. So we're talking pretty big numbers that he was paying out of cash flow rather than hitting the HSA. But when looking at everything else and kind of looking at it all together, his other assets along with just the trajectory of their financial plan and the fact that they did not have any children, we determined that it may make sense to start utilizing that HSA money because unlike a lot of the other investment vehicles that are out there, the HSA is actually probably one of the least estate planning friendly. And what I mean by that is if the original account owner passes away and that health savings account passes on to a non-spouse beneficiary, unlike an IRA where you have maybe 10 years to take out all of the money and recognize income taxes, so you can kind of spread it out evenly. A health savings account on the date of death in that year, the person who inherits that account must pay ordinary income tax on the accumulated value of the account, whatever the value is at that time. That's what they're on the hook for. So it's not very friendly when it comes to estate planning. So we said, did you keep a good job of tracking the medical expenses and keeping receipts over those years? And he said, oh yeah, I've got every receipt. So we actually went into his HSA and we reimbursed him for $40,000 of his medical expenses. And we actually took that money, well, I shouldn't say we, he took the money and went and bought himself a car with tax-free money.
See, that's such an interesting, smart technique to utilize because a lot of people, they're not sure what they should do. Maybe their cash flow's a little tight or they want to utilize their HSA. But if you're on the fence, what you could do is, take it out of cash flow or another bucket, keep the receipt, and then if you want to come back and withdraw funds from the HSA, you're eligible to do that. Again, ideally what we want to do is keep money there as long as possible so it grows tax-free and utilizes tax-free growth. I think a lot of people get mixed up with an FSA, which is basically the exact opposite, right? Yeah. Where you go to your employer at the end of the year and tell them how much you want to defer for the next year. Basically, what you'll do is you'll go to your employer and you'll say, I want to put $1,200 in my FSA. And they will front load you the money at the beginning of the year, and then it will come out of your paycheck each month, so $100 each month. And it's a use it or lose it policy. So roughly you have about a year, sometimes there's like a 3-month extension where you have to spend that money or you basically just lose it. All right, well,
okay,
we'll try to finish up here real quick.
Yeah.
Exactly. So people are kind of like brainwashed with that, where the FSA, with the HSA is the exact opposite, where you want to keep money there as long as possible so you can utilize that tax-free growth.
And it's yours. That's an important note here. That HSA is yours. That's your money. If you leave the company or whatever the case may be, it's just like a 401k or a traditional IRA in the sense that you own it, right? So you can take it with you wherever you go, and you don't have to spend it all in 1 year. We actually encourage the opposite, and that's to try and leave it alone as much as possible.
Absolutely, put it perfectly.
How are we?
We're done, yep.
All right, so we're out of time. I think that's anything else. I think we probably covered it pretty well in 10 minutes, but thanks for tuning in. Be sure to check out our other episodes and tune in for future episodes where we'll discuss more financial planning concepts in depth, and reach out to us with any questions. You can reach us at kmgfp.com. We also have social media handles with the same title as KMG Fiduciary Partners. We're on Facebook. We're on LinkedIn. Anywhere else?
Not yet.
All right.
Maybe Spotify soon, we'll find out.
All right. Well, thanks for joining.
Thanks for joining us for this edition of the KMG Fiduciary Partners podcast. We invite you to catch the next episode in our series for real-world advice from the KMG team. Follow us on LinkedIn at KMG Fiduciary Partners, where we'll keep the conversation going.